Good morning, everyone. Well, the action yesterday was in global bond markets as yields in the UK, Germany, and the US slid to lows for the year. The Bank of England's inflation report was less hawkish than many market participants had expected. In particular, the inflation forecast made on the basis of market interest rates showed inflation slightly below target in 2 or 3 years' time, which suggests the bank has room to raise rates at a slower pace than the market expects. As a result, UK yields fell across the curve. 10-year yields were down 10 basis points. As for cable, the assault on 170 is on hold for now, although the technical picture does still look bullish. On the continent, both core and peripheral bond yields fell as the market continued to price in an easing of monetary policy at next month's ECB meeting. Executive Board member Mersch confirmed that ECB President Draghi's recent comment about the Council being comfortable moving in June was really a coded statement meant to convey to the market that a change in policy was imminent. 10-year Bund yields declined by 5 basis points to the lowest level since the talk of the Fed tapering began last year. And even U.S. bond yields joined in the global rally, even though U.S. producer price inflation hit a 2-year high in April. The 10-year note was down 7 basis points, while Fed funds expectations collapsed 7.5 basis points in the long end. Now, the FX implications of this global bond market rally are clear. Carry is king. And EM currencies should be doing better as the rally takes the pressure off these countries to raise rates. For example, the ruble was the biggest gainer over the last 24 hours, despite the worsening situation in the Ukraine. Among emerging market currencies, this would tend to favor the Turkish lira, the ruble, the Indian rupee, the Indonesian rupiah, the South African rand, and Brazilian real, although clearly there's more than just interest rates to worry about here. The Turkish lira, for example, was the weakest of the EM currencies we track over the last 24 hours, while at the same time, although the ruble did very well overnight, personally, I wouldn't recommend the currency right now for obvious reasons. Among developed market currencies, the New Zealand dollar, Australian dollar, and Norwegian krone would tend to be benefits of increased emphasis on carry, although personally, I think the Australian dollar is headed lower. During the European day, Eurozone preliminary GDP for the first quarter is expected to have accelerated from fourth quarter. Eurozone final CPI for April is also coming out. The big thing, though, is likely to be the ECB monthly report. In particular, it's the survey of professional forecasters on inflation. It's coming out at the same time. Much of the recent data suggests inflation forecasts should be unchanged to higher. So, if forecasts are instead revised lower, it would tell the ECB that inflation expectations have declined. And that would be a strong signal to the Council that they need to take some action. There's a lot of data coming out from the U.S. today. I'll just mention the CPI for April because CPI tends to have the biggest impact on FX out of all the indicators that will be released. Headline CPI is forecast to have accelerated to 2% year-on-year from 1.5%. That should be bullish for the dollar as it makes it more likely that the hawks on the FOMC will argue for early tightening. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.